welcome to the deep dive. Let's jump right into something a lot of folks wonder about when they're, getting started with their money.
Yeah.
Can you actually begin investing with just $100?
Right.
Because that feeling that you need a mountain of cash to even get in the game, it's a real one.
It absolutely is, and that's really the myth we're tackling today. The truth is, the whole landscape of investing has changed dramatically, offering some truly accessible paths for newcomers. We've got some great material here that really shines a light on how to make that first $100, work for you.
Exactly. Our mission in this deep dive is to explore those smart, beginner-friendly strategies specifically for you in the US and Canada who are ready to take that initial $100 and start building towards your financial goals.
Yeah.
We're going to try and break down some concepts that might seem intimidating and give you some clear, actionable ideas. Okay, so before we even think about where to put that first $100, what are the absolute must-dos, the prerequisites?
That's the perfect place to start, because even with the small amount, having a solid foundation is, it's crucial. Our sources emphasize a few key steps.
Okay.
First off, a basic emergency fund. We're talking maybe $500 to $1,000, something like that. It acts as a safety net.
Right.
You really don't want to be forced to sell your investments if, unexpected expenses pop up.
That totally resonates. It's like having a financial buffer, right?
Oh, okay.
So a small bump in the road doesn't derail your bigger plans.
Yeah.
What else is on that essential checklist?
Well, managing high-interest debt, like credit card balances, that's another really important piece of the puzzle.
Yeah.
The interest you're paying on that debt can often just eat away at any potential gains from your initial investments. It's about making sure your money is working for you, in the most effective way possible.
So prioritize knocking out that expensive debt first. Makes sense. Okay, now what about how you think about investing? Does mindset even matter when you're only starting with $100?
It truly does, yeah. Understanding your own comfort level with your risk tolerance, it's key, even with a small sum. Think about how you might feel if that $100 saw a temporary dip in value. This helps guide you towards investments you'll actually be able to stick with.
Okay.
And finally, setting a simple investment goal. Even if it's just, I want to learn the ropes, or I want to build a long-term saving habit, that gives you direction and purpose right from the start.
All right, solid groundwork laid, foundational stuff. Now let's get to the exciting part. The smart ways to actually invest that $100. And our sources highlight 7 really interesting approaches. Let's kick off with fractional shares. This sounds like it's really opened up investing to a lot more people.
Oh, absolutely. What's truly transformative about fractional shares is the access they provide. You're essentially buying a slice, a portion of a company's stock rather than a full share.
The slice.
So even if a single share of a big name like Apple may be trading around $180 or Microsoft perhaps closer to $400, even if that costs more than your $100, you can still become a part owner. And crucially, you benefit proportionally from any movement in that stock's price, up or down.
That's fantastic. So you're no longer excluded from investing in these major companies just because of the share price. Which platforms are making this possible? Are they common?
Yeah, several popular online brokerages have really embraced fractional shares, often alongside commission-free trading, which is another big plus.
Right.
Names like Fidelity, Charles Schwab, Robinhood, SoFi Invest, M1 Finance, Public.com. These are key players in this space now.
Then for someone starting with just $100, the advantages here seem pretty significant, yeah?
Absolutely. Beyond just getting a foot in the door with those blue chip companies, it allows you to diversify even with a small amount.
How so?
Well, for instance, you could allocate, say, $25 to 4 different companies with your $100.
Oh, okay.
It also makes something called dollar cost averaging more feasible. That's investing a fixed amount regularly, and you typically still receive dividend payouts in proportion to your ownership. Full shareholder rights, usually.
Okay, so how does someone actually do it?
Yeah.
How do they buy these fractional shares with their $100?
The process is generally very user-friendly these days. You select one of those brokerages we mentioned, open an account which is mostly online, and fund it with your $100. Then you'll want to do a little research. Maybe consider companies whose products or services you use and understand. Or look for ones with a history of financial stability, long-term potential.
Right, do some homework.
Exactly. When you place your order, you simply specify the dollar amount you want to invest in a particular stock, not the number of whole shares. So you'd say, buy $25 worth of Apple.
It sounds incredibly accessible. Now, it's important to keep in mind, as our sources remind us, that all stock investing including these fractional shares, carries risk, right? The value can go down as well as up.
That's the fundamental truth of investing, yes. Risk is always part of the equation.
Okay, now another really interesting option mentioned is exchange-traded funds, or ETFs. What makes these so attractive for beginners, especially with just $100?
Well, if we think about building a well-rounded portfolio, even with a modest start, ETFs are a fantastic tool. Picture them as ready-made baskets.
Baskets?
Yeah, baskets holding a whole collection of investments. Could be stocks, could be bonds that trade on an exchange just like a single stock.
I see.
So when you buy just one share of an ETF, you instantly gain exposure to all the underlying assets inside that basket. It's a great way to spread your risk automatically.
Instant diversification, that sounds like it could really ease some of the anxiety a beginner might feel.
Yeah.
What are some good types of ETFs to consider when you're just starting out?
Index ETFs are often a go-to recommendation. These are designed to mirror the performance of a specific market index.
Like the S&P 500?
Exactly. An S&P 500 index ETF holds stocks of the 500 largest U.S. companies. Gives you broad exposure right there. You also have total stock market index ETFs for even wider coverage.
Okay.
Then there are sector ETFs, which focus on specific industries like tech or healthcare or maybe renewable energy. But a heads up, these can be more volatile and usually need a bit more research.
Makes sense. More concentrated risk.
Right. And finally, bond ETFs. They invest in bonds, generally considered lower risk, but typically offer lower growth potential too.
So just to clarify, with that $100, you could potentially buy a share of an S&P 500 ETF and instantly have a tiny stake in 500 of the biggest companies in the US.
Precisely that. And what's particularly appealing for beginners is that many of these broad market index ETFs have very low expense ratios.
Expense ratios, like fees.
Yeah, think of it like a small annual management fee, often less than 0.10% for the big index ones. Super low. Plus, they trade just like stocks. Many brokerages offer commission-free trading, and some even allow fractional shares of ETFs now too.
Wow, okay, so how does someone go about choosing an ETF with their initial $100?
Good question. First step is consider your investment goal. If you just want broad market exposure to start, an S&P 500 or total stock market ETF is a really solid choice. Then check the share price. Does it fit your $100 budget? Or are fractional shares an option? Keep an eye on that expense ratio. Definitely aim for low-cost options.
All right, minimize fees.
And finally, maybe take a quick look at the ETF's main holdings just to make sure it aligns with your comfort level with risk and your goals.
Okay, ETFs sound like a really efficient way to achieve diversification right from the beginning.
Yeah.
Great option. Now let's move on to micro-investing apps. These seem to have become incredibly popular lately. What's the scoop on them?
Yeah, they really have taken off. These apps are all about simplicity and automation. They make investing small amounts, like $100, incredibly user-friendly, especially for newcomers.
How so?
Well, they typically feature very intuitive interfaces, really easy to navigate, and often provide educational resources along the way. Key features usually include things like roundups.
Oh, where it rounds up your purchases.
Exactly. You buy a coffee for $3.50, it rounds up to $4, and that extra 50 cents gets invested automatically.
Clever.
Yeah, and recurring investments, where you can set up automatic small contributions like $5 a week or whatever works. Many also offer pre-built diversified portfolios, often using those ETFs we just talked about, tailored to your risk tolerance.
That roundup idea is pretty ingenious. It's like investing on autopilot without even really noticing it. Which apps are the main players in this space?
Popular options include Acorns, which is really known for that roundup feature and usually invests you in diversified ETF portfolios.
Okay.
There's Stash, which lets you choose individual stocks and ETFs or opt for their curated portfolios. And even Robinhood, while more of a full brokerage, also supports small recurring investments and fractional shares.
So what are the main upsides and downsides of using these apps when you're starting with just $100?
The pros definitely include the ease of use and the automation. That can really help build consistent investing habits, which is huge. The low minimum investment requirements are perfect for starting with $100, and many offer that built-in diversification. However, you do need to be mindful of fees.
Ah, the fees.
Yeah, monthly subscription fees, even if small, can take a larger percentage bite out of a very small account balance. Also, the investment choices might be more limited compared to a traditional brokerage, and with those pre-built portfolios, you might have less direct control over exactly what you're invested in.
That point about fees is crucial. Definitely something to watch, especially when you're starting small.
Yeah.
Okay, now, our sources also mention high-yield savings accounts, or HYSAs. Now, this isn't technically investing in the stock market, right? So why is it a smart move for a beginner with $100?
You're right, it's not stock market investing, but what's really valuable about HYSAs for beginners is the safety and predictability they offer. These accounts, typically found at online banks and credit unions, provide significantly higher interest rates, the APY, compared to traditional savings accounts at, say, big brick-and-mortar banks.
Okay, higher interest, that's good.
And importantly, in both the US with FDIC insurance and Canada with CDIC insurance, your deposits are insured up to a certain limit, usually $250,000 in the US. So your $100 is safe while it earns interest. Plus, they offer easy access to your fund's liquidity and usually have very low or no fees.
So it's a completely risk-free way to at least see your $100 grow a little bit, maybe while you're getting comfortable with the whole idea of putting your money to work.
Exactly. It's a fantastic way to build the habit of saving, watch your balance increase, even if it's at a more conservative pace than the stock market might offer. But the difference in interest earned compared to a traditional savings account can be quite substantial, especially with rates where they've been recently.
Okay, HYSA is a safe place to start or park money while learning. Got it. Now here's a really interesting one. Investing in yourself. How can you possibly do that with just $100, and how does it tie into future investing?
This is one of my favorites, actually. It's often overlooked, but it can be an incredibly powerful form of investment. By investing in your own knowledge and skills, you can significantly boost your earning potential down the line, which in turn provides you with more capital for traditional investments later on. The potential return on this type of investment can be, well, tremendous. Think of it as laying the groundwork for future financial growth.
So what are some tangible ways you could invest $100 in yourself? What does that look like?
Our sources give some excellent examples. Online courses, maybe. Platforms like Udemy, Coursera, Skillshare often have options well under $100.
Right.
Focusing on in-demand skills,
Right.
digital marketing, coding basics, graphic design, data analysis, writing, things like that. You could also invest in valuable books on personal finance, investing itself, business skills, even attending a low-cost introductory workshop or webinar online, or maybe buying study materials for a professional certification.
Interesting.
Even a month's subscription to a helpful software tool like a language learning app or a design program can be a fantastic investment in yourself. We even heard a story about someone, Sarah, who spent $99 on a freelance writing course. That led to a significant increase in her income, which she then used to start investing in the stock market. That's a real example of a high-return self-investment.
That really puts it into perspective. That initial investment in yourself can truly pay off down the road, both career-wise and for your ability to invest more later.
Yeah.
Okay, now for those who might be interested in dipping their toes into individual stocks for the long term, especially now with fractional shares available, our sources mention dividend reinvestment plans, or DWEPs. What exactly are those, and how can they help a small initial investment like $100 grow?
Right, so for long-term individual stock investors, especially when starting small with fractional shares, DREPs are a really powerful mechanism for compounding returns. So first, dividends, that's basically a portion of a company's profits shared with its shareholders.
Okay, profit sharing.
Yeah. A DRP dividend reinvestment plan takes those dividend payments you receive and automatically reinvests them back into the same company's stock. It buys more shares or even fractions of shares. Automatically, and often without any additional commission fees, which is key for small amounts.
So your small initial stake starts to build on itself over time, almost like magic.
Precisely. It's the power of compounding in action. The dividends buy you more shares, those additional shares then generate more dividends in the future, and so on. It's a really effective form of passive dollar cost averaging too, and it can significantly amplify your overall returns over the long run. Now, obviously, the initial dividend payouts on a $100 investment in one stock might be tiny. We're talking pennies, maybe.
Right.
But establishing this habit, this automatic reinvestment early on, is key to harnessing that compounding power later. You'd want to look for companies that reliably pay dividends, sometimes called dividend aristocrats, and use a brokerage that offers both fractional shares and the option to automatically reinvest dividends. Many of the big ones do.
That sounds like a fantastic long-term strategy, even starting small. Okay, the last of our 7 smart ways is peer-to-peer lending, or PDP. This sounds a bit more intricate, maybe riskier. What does it involve?
It is definitely more complex, and yes, it carries a higher degree of risk. So it's something beginners, especially with just $100, should approach with significant caution.
Okay, Caution advised.
Peer-to-peer lending platforms basically connect individuals who want to borrow money directly with individual investors like you who are willing to lend. You can often invest relatively small amounts, sometimes as low as $25 per loan note.
So you can split $100 across 4 loans.
Potentially, yes, that's the idea. Borrowers then repay the loans, including interest, usually on a monthly basis.
So the attraction is that you could potentially earn higher returns than, say, in a savings account.
That's the potential upside, exactly. Returns can sometimes range from 5% to 10% or even higher, depending on the risk level of the loans you choose. And with $100, you could theoretically diversify across a few different loans on the platform. However, the risks are considerable.
Like what?
The primary risk is default. Borrowers might not repay their loans. If that happens, you could lose your principal and any expected interest. Yeah. There's also platform risk. What if the platform itself has issues? There's often a lack of liquidity. Your money might be tied up for the term of the loan, and selling your loan note isn't always easy. And frankly, it requires more homework understanding the risk grades, borrower profiles.
Right.
Plus, given that typical $25 minimum per note, your $100 only gets you maybe 4 loans. That really limits the diversification benefit.
So while there's the lure of potentially higher returns, it definitely sounds like it comes with a significant jump in both risk and complexity. Maybe not the best first step for someone just starting with $100.
That's a crucial point to understand, I think. P2P lending might be something to explore much further down the line once you have more investing experience and maybe a more diversified portfolio already built up. For now, the other options we've discussed are generally much more suitable for beginners.
Absolutely, and that brings us to a really important point our sources emphasize. Regardless of which path you choose, it's vital to have realistic expectations.
Oh, true.
You're not going to get rich quick with a $100 initial investment, right?
Not happening overnight, no. The primary focus really should be on learning the process, developing those consistent habits of adding to your initial investment over time. That's key. And being very mindful of fees, especially when you're starting with smaller amounts. Low cost is the way to go.
Right?
Exactly. Think of that $100 as the seed. It's the consistent contributions over time combined with the power of compounding that allow that initial investment to potentially grow into something more substantial down the road.
So just to quickly recap, we've explored a really diverse set of strategies for putting that first $100 to work. We talked about fractional shares.
Yep, getting a piece of big companies.
ETFs for instant diversification.
Those baskets of investments.
Micro-investing apps for ease and automation.
The roundups and recurring deposits.
High-yield savings accounts for safety.
Risk-free growth while you learn.
The powerful idea of investing in yourself.
Boosting future earning potential.
Dividend reinvestment plans for long-term compounding.
Letting your money make more money automatically.
And a word of caution about peer-to-peer lending for beginners.
Definitely approach that one carefully. So the key takeaway for you, our listener, is really that taking that first step is the most important thing. Don't let that misconception that you need a huge sum of money hold you back. That $100 can indeed be the foundation for building long-term wealth, provided you invest wisely and, crucially, consistently add to it over time. Embrace the learning process, be patient, and remember, every dollar you invest is a dollar working for your future.
Well said. And of course, we need to include our financial disclaimer. The information we've discussed today is intended for general informational and educational purposes only. It should not be considered financial advice.
Right. Always best to consult with a qualified financial advisor before making any investment decisions. All investments involve risk, remember that. And it's worth noting, our sources also have a really helpful FAQ section. It addresses many common questions beginners ask, like, is $100 really enough to start? What's the safest way? What kind of returns are realistic? What about taxes? What are the next steps? What should I avoid? It's a valuable resource as you take this first step.
Absolutely, check that out.
Yeah.
And hey, we'd love to hear about your experiences or any questions you have. Please share your thoughts in the comments. Let's learn from each other here.
Yeah, definitely.
And if you found this deep dive valuable, maybe share it with other beginners you know. Be sure to explore more resources on Penny Nest and subscribe for more beginner-friendly personal finance insights. Thanks for joining us for this deep dive.